This video is part of a series that applies psychology to financial planning so we can all make wealthier decisions. As a multi-billion-dollar investment and planning firm, Mission Wealth is able to give you collective wisdom and real-life examples from thousands of multimillionaires. I'm Joey, a practicing wealth advisor and professor that studied behavioral finance with Cornell and Harvard. Each quarter, we publish 1 to 3 psychological topics that are relevant to what's going on in the world around us. This quarter, we're going to talk about how markets behave in a presidential election year. But before we dig in, I'd like to start with a review of how people generally feel about the economy relative to their favorite political party. By the end of this update, we'll be able to see if how people feel matches with reality. So Pew Research data shows that Americans generally rank economic conditions better or worse depending on whether or not their favorite political party is in office. Take a look at this chart. Pay special attention to which colored line sits on top. The lines correspond with political parties, red for Republicans and blue for Democrats. Whichever line is on top tells you which voters feel better about the economy. From 2000 to 2009, when Republican George W. Bush was in office, Republican citizens rated the national economic conditions better than Democratic citizens did. The red line sits above the blue when Bush is in office. This immediately reverses when Democrat Barack Obama was in office from 2009 to 2017. Suddenly, Democrats are ranking the national economic conditions as good, while Republican citizens lose confidence in economic conditions. The blue line is above the red line. The trend reverses again when Republican Donald Trump takes office in 2017 to 2021. The red line is now above the blue line, and comically flips once more when Democrat Joe Biden enters office in 2021. Blue line now sitting above the red line. It is clear that the perception of how healthy the economy is doing largely depends on whether or not your favorite political party is in office. But is there any data to back this up? There's one more curiosity in this chart before we unveil the answer. Did you happen to notice how often both the blue and the red lines are below 50%? This would indicate that a minority of voters from both parties felt that economic conditions were good. Said differently, it would indicate a majority felt that economic conditions were not good when the line is below 50%. Meanwhile, over the same time period, from 2000 to 2023, the S&P 500 grew by 250% and GDP grew by 285%. How is it possible that a majority of people, for a majority of the time, ranked economic conditions as poor while we've had one of the greatest economic expansions in history? A deeper look into how the stock market, represented by the S&P 500, and how the economy, represented by GDP growth, have fared under each party. There are 3 key conclusions. Democrats win the GDP race. A unified government under Democrats has historically produced better GDP growth compared with Republicans. 4.0% average annual year-over-year real GDP growth under United Democrats versus 2.8% under Republicans. But Republicans win the S&P 500 race. United Republican Party has historically produced better S&P 500 growth compared to Democrats, 12.9% average S&P returns under Republicans versus 9.9% under Democrats. But here's the real catch. Nobody wins when the government's divided. A divided government has historically produced inferior results for both GDP growth and the S&P 500, 2.7% GDP growth, 7.9% S&P. A united government under either political party has historically performed better on average in both the S&P 500 and the GDP. Now, I know what some of you might be thinking. This makes sense over the long term, but what about how the market behaves in an actual election year? Here's the reality. Markets generally don't care about elections, but recent elections make us feel differently because they were associated with non-political market shocks. The visual that we've got pulling up shows you the volatility in the market in the 100 days before and after elections. It's important to realize that we have had 3 global events in recent presidential election years, which are totally unrelated to the elections themselves. 2020 was met with COVID, in 2008 we had the Great Financial Crisis, and in 2000 we were met with the dot-com bubble. These can falsely lead people to conclude that markets are risky during election years. But if we strip these out, you can actually see what the volatility looked like in other election years like 84, 88, 92, 96, 04, 2012, and 2016. These are the bluish green lines in the visual. And you can see that the market normally ignores elections. In fact, Markets on average are less volatile during presidential election years, 14% standard deviation compared to the average of 15%. This data goes back nearly 100 years, and it points to the same conclusion. Presidential elections do not negatively impact markets themselves. Counterintuitively, markets tend to be higher on average during presidential election years, averaging 11.6% in the S&P 500 versus the long-term average of 10.3%. This creates a huge missed opportunity for investors that are mostly politically driven. If you chose to only stay invested when your preferred political party was in office, you'd miss out on approximately 45% of all growth in the prior 10 years. And in the prior 70 years, you would have missed out on approximately 97% of the growth in the S&P 500. The bottom line is clear. Politics isn't profitable. Companies will always seek to earn profits and innovate regardless of which political party is in office. Investors generally tend to have perceptions of economic conditions that are too closely associated with which political party is in office. And choosing your investments based on your political preference is a great way to lose out on most potential earnings over the long term. Historically, the market has averaged higher returns with less volatility during presidential election years. Human ingenuity, innovation, and progress will not stop because of whichever president warms the seat in the Oval Office. We hope you found these topics helpful as we enter the spring season. And for more detailed market commentary, I welcome you to watch or read our Chief Investment Officer's market updates from our Inspired Insights blog. To submit requests for future topics, please don't hesitate to email me directly at jkhoury@missionwealth.com. Wishing you a wonderful spring season ahead. Thanks so much for spending some time with us.